So with that, Craig, why don't you come up? He's the Chief Economist and Director of the Division of Economics and Risk Analysis at the SEC. He's currently on leave from Vanderbilt University, where he is the Madison S. Wingington Professor of Finance at the Owen Graduate School of Management. That is a huge mouthful. You do know that, right? Okay. He has also done a tremendous amount in this space, and as I mentioned to you when I heard him in Dublin, I thought he was had such great insights and was going to make a lasting mark on the SEC forever. So very much appreciate you're here, and the floor is yours.
Okay. Thank you, Arlene. Thank you, Campbell. And so I thought I want to thank you for inviting me and giving me the opportunity to come to the conference and talk about some of the work that my division is doing using XBRL data and thinking about data analytics more broadly. The remarks this disclaimer has probably never been more apt, but the remarks that I'm about to make today are my own. They do not reflect those of the chair or the commissioners or any of my colleagues at the agency. So it's unfortunate that Congressman Issa actually isn't in the audience today so that I would have a chance to rebut directly to him, but I look forward to an opportunity to maybe speak with him at some date in the future to actually let him know what we are trying to do and to assuage his concerns about our lack of competence in the area of data analytics. So let me tell you a little bit. I'm going to organize my remarks this morning. I'll describe my division briefly, some of the initiatives and what has led us to the development of what we refer to as the accounting quality model, but what the press has picked up as RoboCop or dubbed RoboCop. I'm the director and the chief economist of the Division of Economic and Risk Analysis, formerly titled the Division of Risk Strategy and Financial Innovation. So if you thought my professorial title was a mouthful, I felt the same thing about the former name of my division and thought that one of the things I asked Chair White when she became the chairman was whether or not we could change the name of the division to better reflect what it actually is we do. The DERA, as we like to call it at the agency, is really the group that houses the economists. So my staff currently is close to about 110 people. Approximately half of those are PhD economists or have advanced degrees in computer science or mathematics or statistics. We are the place, and our division was designed to be the think tank, if you will, for the agency, and we represent the group that tries to do rigorous data analytics using data that is available to us. As a result of that, and with that initiative, when I became director a little over 2 years ago, I formed what we call the Office of Quantitative Research. And that office is really, the purpose is to build risk assessment tools, to build an internal data warehouse, if you will, to sort of feed those risk assessment tools. But that group has had a number of successful initiatives. And I think our first one was something that's called the Aberrational Performance Inquiry Model. If you haven't heard of that, that was really the first risk assessment tool that we developed. What it did was it took and evaluated voluntarily reported returns that hedge funds were providing and attempted to look for outliers, people that stood out from the pack on a number of different dimensions. If you wanted to think about it intuitively, imagine that you were trying to find the next Bernie Madoff in returns, and to the extent that some of the past enforcement actions had specific characteristics, that we could build a model that would effectively score firms on how closely they matched to some of those characteristics. And to date, it's resulted in 7,000 enforcement actions. 7,007 enforcement actions. Maybe 7,000 attempts to find an enforcement action, but really only 7 enforcement actions. But we've been successful, and it actually has identified several Ponzi schemes, for example. So one of the reasons I bring this up is that in order to develop a risk assessment tool like this, we basically in the division had to start with a blank slate. And the blank slate we started with was a desire to build risk assessment, but also to have a platform in place that could deliver the results from a risk assessment program broadly throughout the agency to the various individuals that would actually be responsible for performing the actual risk assessment. So risk assessment tools are great in that you can go through a large set of registrants and identify outliers, but then the next step is once you create a set of outliers, you actually need to be able to allow the people that are responsible for evaluating those a tool or report, if you will, that will help them in that process. And so we built there's an infrastructure build that took place where effectively we developed a report generating tool. And so this report generating tool can take data, take an analytic model that we build and literally feed that data on a real-time basis and generate reports on demand for the users. So somebody in enforcement, someone in Corp Fin, someone in OC, the Office of Compliance and Inspections and Examinations, can literally log on to the system. The system will look at their credentials, decide what security level they have, wall off pieces of information that are relevant to them so that they can go in and do queries and build and generate reports. By having that technology built in place, it has now allowed us to leverage that tool so that we can think about risk assessment more broadly. We've recently developed a broker-dealer risk assessment model that uses XML data that's been collected on our behalf by FINRA, for example. And we've used the point of today's discussion, which is a similar initiative to develop something called the accounting quality model. What the accounting quality model really is its core, is it's an attempt to build a structured analytic model that takes filer information and identify outliers. Try to identify firms that stick out from the pack in terms of the types of accounting disclosures that they're being made, and use that as a basis for trying to better understand our filer space. And so in my initial vision for how this tool would be used, I saw it as a tool that could be primarily used by the Division of Corporation Finance to assist in their review process. I also think that it has applications for enforcement, and you can see that the Division of Enforcement has actually ramped up its investigations into accounting fraud, and this is one of the tools that is being used by the division as they try to identify accounting fraud cases. I would say, though, that the reason it's called the accounting quality model and not the accounting fraud detection model is that the real intent of the build was to assist the review process in trying to improve the actual quality of the financial disclosures that are being made in firms' 10K and 10Qs. To the extent that we're able to use the tool to identify fraud, I view that as almost a second-order benefit that comes from a more general program, which is to simply assist review teams in highlighting areas for additional investigation when you go through and do a review. So I thought that it would be particularly apt in this case because it's mandated under Sarbanes-Oxley that we actually review every filer at least once every 3 years. And I felt if you already are on the hook to look at everybody on a regular basis, it would be nice if you could have a tool that would score firms on an aggregate level on the basis of risk, but then actually have an ability to point to areas in a firm's financial statement before you actually open the 10K that might bear a little more time and energy than taking it and starting from scratch. So that was really in the back of my mind what was going on. By the way, I'm a former auditor. I used to work for a firm called Arthur Young. So I do have an accounting background of sorts, even though I'm actually a finance professor in my other life away from the SEC. But the real idea is to use these scores, and so the model itself really flows from the financial accounting academic literature. So if you think about accounting numbers and the difference, so what we're really trying to look at is something we call total accruals. Total accruals are really the difference between a firm's cash flow and income before extraordinary items. The difference between those two represents the accruals that firms have booked to try and better reflect financial performance. That number is really, in our view, decomposed into two distinct pieces. One is we call non-discretionary accruals, and the other piece we call discretionary accruals. Non-discretionary accruals simply represent the accruals that a firm makes where it has very little play in the numbers. Depreciation of assets, right? That's to a large extent non-discretionary. Asset lives are determined ex ante, the type of assets, so there isn't a lot of choice you have there, but accruals for other types of liabilities that require significant judgment actually open the door for a fair amount of, let's say, push or play. And so what we're trying to do with the model is actually model that discretionary piece, and that is really the score that the model attempts to generate. And so the existing accounting literature has an approach for doing this, which effectively says model non-discretionary accruals, and then in a regression type framework, and then let the residual from that model, the part that's unexplained, be your measure of how much discretion a firm has actually used in a given year. What we are doing is we are expanding that literature or that approach, and that in addition, what we're doing is we're trying to model these non-discretionary pieces, but we're also attempting to model a firm's discretionary choices. And we break this down into two types of factors that are feeding the model. One would be a set of factors we call risk inducers, and risk inducers reflect the idea that there may be circumstances that will motivate a firm to manage its income in a particular way. If you are performing poorly relative to your industry, there will be incentives to try and find ways to boost income so that you look less like a poor performer relative to your peer group. If you're in a situation like that, we would think of that as being a factor that could feed the model. That's important to understand. We don't think that's indicative of anything unusual going on. You could be doing this in a way that's completely consistent and falls within the broad contours of generally accepted accounting principles. But it can create a profile, if you will. If enough of these elements are in place and they seem to be important, it suggests that maybe something is worth taking a deeper look at. We also have factors that we call risk indicators. And risk indicators would be elements or ideas that suggest a firm may have been actively engaged in some type of earnings management. And those are informed to a certain extent from past SEC actions, AARs, accounting and auditing and enforcement actions. We can look at those actions and find out what type of events or what type of activity actually led to the SEC taking some type of action in the past, and we can learn from that, and the events or the circumstances that actually resulted in past enforcement actions should be something we think about when we model. So in my mind, it could be something as simple as, think about Enron. Enron had a lot of off-balance sheet financing. So you could imagine a factor that asks the question, do you use off-balance sheet financing? Doesn't mean there's anything wrong, but it's part of a broader profile. And so, did you switch your auditor? There's a lot of reasons to switch auditors. One may be you don't like the opinion that you're getting from your current audit team. So those are factors. None of them actually indicate anything bad is happening, but they do point out a broader sort of profile for the company. So that's the core of the model. And what we're trying to do when we build one of these models is to develop something that can be used and put into a quantitative framework. So it's fed by quantitative factors. It creates a score. The scores then can be used to rank firms on the basis of risk, and you could think about using that to actually schedule the review process in Corp Fin. And so you take these risks, you score firms, you identify the firms that you're going to look at in a particular year. Once you have the score, because it's generated or created by essentially compiling these factors, the factors that lit up or were important also point in the direction that you might want to take your review. And so underlying that is kind of where we actually think the model has a lot of utility. One of the things that we did to try to see how effective the model was, so we developed a prototype for the model, and we asked the following question: now that we have scores, how does it work? And so we actually looked at the scores that came out of the model, and we compared those scores to firms that actually had past AAER actions taken against them. And we looked at the distribution of these scores, And we compared that to the distribution of scores for firms that had never had an accounting action filed against them in the past. And while there are a lot of false positives in a model like this, what we did find is that firms that had high scores had a much higher rate of having an enforcement action taken against them in the past, which we felt was a real positive signal. These models aren't perfect, but anything you can do to increase the odds that you're going to find something of interest, in my view, is a worthwhile effort to be undertaking at the agency. So to a large extent, I felt the model, while not perfect, was moving in the right direction. So the next thing that we have really started to do, and how much time do I have?
You're good.
Okay, so the next thing we decided to do was there's a lot of information that is contained in a firm's 10K filing, 10Q filing, that is not financial statement data, right? It's actually text data. And so the next step in our risk assessment model has been to try and use textual analysis, find out what firms are actually saying in their 10Ks, and try to understand that as well. So the way I think about it as a professor is that text analysis is used in academia to identify plagiarism, right? And so one of the things that textual analysis can do is effectively what you're doing is you can look at everybody who writes uses a particular vocabulary, right? And what we're trying to do is ask, when you select a particular vocabulary, are you saying something that's distinct, right? And so in the academic arena, what you do is you look at the vocabulary of a student's term paper and you compare it to a set of well-known classic works in the area, and if there's enough similarity between what the student is saying and what these classic papers in this area are saying, it allows you to throw it as an outlier, bring it out as an outlier, and actually look to see whether they've actually lifted words directly from sources without citing them. What we're thinking about is that same idea, that we're thinking maybe firms that are fraud firms have distinct vocabularies, and that they make representations in their financial statements that are different than non-fraud firms. So imagine trying to calibrate a set of fraudsters that we know through past AAR actions to firms that have never had an AAR action filed against them, control for industry vocabulary, and see if fraudsters say things that are different from non-fraudsters. And one of the things that has emerged from our research is pretty common sense. And what we find is that firms in their vocabulary choices, or the word choices they make, tend to speak to benign elements in their financial statements much more than non-fraud firms. And they tend to under-discuss risks, key risks that are facing the industry. So it's a very common sense result. So what we have is there's a secret sauce, if you will, that we have that will allow us to take this textual content and create factors. And it will basically create sets of topics that will generate scores. And so while the word choices themselves and the topics themselves, I think, are very interesting and important, the fact that we can use this in a quantitative way to build factors allows those factors to then be linked back into our accounting quality model. And so the reason why I'm particularly excited about the textual analysis piece is that as the factors in the quantitative model point to specific elements that are numeric in a firm's financial statement, the text analysis allows us to point to particular topics, if you will, that are either being over-reported or under-reported. It's not necessarily about finding fraudsters. It's about identifying areas where firms can improve the quality of their textual disclosure to investors. So as you go through a firm's MD&A analysis, are they talking about things in a way that is an outlier or looks unusual? Why are they doing that? It could be that the discussion is incomplete, if they've underdisclosed, and a review team could suggest to the filer in a comment letter that you might want to consider adding more discussion around this particular factor. If you over-disclose or you over-report on certain things, it's a legitimate question to consider, why are they doing this? And so to me, this is a really exciting development in sort of how we're rolling this out. One of the reasons why I think the accounting quality model is particularly interesting to this particular group is that it will be fed by XBRL data. Right? So the underlying idea here is we have an obligation, we require filers to bring this data to the agency and file it along with their paper version of the SEC's 10K report or 10Qs. What we're trying to do is take that data and use it as a part of in our program. So I think, to me, it was one of those places where my division could bring a fairly large value add to the agency by asking, let's use the data we're requiring filers to actually deliver to us. And so, just wrap it up by saying one of the things that when Chair White took over, I asked her to consider was the idea of actually taking the XBRL data and delivering it to the public in an aggregated form. So right now, one of the things that I would say as an academic that always would put a roadblock in front of me as to whether I wanted to actually use XBRL data would be to have to go through the process of learning how to aggregate the data, bring it together in a meaningful way so that I can actually do rigorous data analysis around the data. One of the things that we're looking and exploring is the idea of actually putting the base financial statement data out in an aggregated way in sort of standard data formats, put it on our website so that someone could come down and download the data for analysis purposes. Would be as reported data. We wouldn't do anything to the data. It would simply be take the XBRL filings, consolidate them into a single database, put it on our web page, and allow users to come in and take that down. And so we're thinking about doing this in two stages, really. The first stage would be the base financial statements, income statement, balance sheet, statement of cash. The second stage will bring the detailed footnotes into the data set as well. And that, to me, is where I think the most usage will come from my academic peers, because using text to do research, the hardest thing about doing this is actually stripping out the relevant sections of a firm's 10K. So it's a non-trivial exercise to take a filing, go through, and strip out the MD&A section, for example. If you can just go to a text block that's tagged, it makes that trivial, right? And so I think that there are huge opportunities to do additional academic style research around footnote disclosures, around MD&A sections, and it will only become more valuable. The utility will only go up as time goes by and the database itself grows as more years are added to the database. So we're thinking about doing this. If we were to do this, we would start out probably with something like quarterly updates, hopefully going to higher frequency updates as we became more comfortable with pushing out something like this. So thank you for your time, and close it off and open it up for questions.
Ready for some questions?
There.
Okay. Thank you again, Craig. I love this stuff. It just gets my energy going. So I have 3 buckets of questions that have come from the audience. The first having to do with the AQM itself. The second having to do with quality of data going into the AQM, kind of garbage in, garbage out kind of a situation. And then I've just got some miscellaneous questions. Sure. So should we start with the AQM first?
Whatever you like.
Okay. The question came in is, are you actually using the AQM today? And is it in place? And if not, when will it be fully utilized?
So there is a version of the AQM model that's actually available today. I view it as more of a prototype model, in that to date it only actually incorporates factors that are derived directly from financial statements. In the original formulation of the AQM model, which is something I did while I was visiting the SEC as an academic, there's a significant amount of additional information that we sort of aspirationally plan to add to the model. So we're using it, although I think it's not as valuable as it's going to be a year from today. And what I have in mind is adding information about market conditions, stock price information that can be derived from equity research analysts. You know, just a variety of different sources that financial analysts would use to do fundamental research around a company. I think the AQM model can benefit from additional data sources than simply taking financial statement data as we currently are doing.
Okay, and there are two questions that came which went exactly where I went in Dublin, which is that when I heard this, my first thought was, by George, if I were a large multinational, I'd figure out how to parrot that report, that process inside, because I would want to know what you were looking at. And so do you ever see, first of all, making that report generator tool, if you will, open to the public? And second of all, do you have any concerns that as individuals learn more about it and understand the detection and the analytics that are going on, that it will cause it to become obsolete because they will just change their behaviors, they being the targeted entities?
Sure. So 2 questions basically. Are you going to make the underlying model available to the public? And even if you don't, are you worried about it eventually becoming obsolete?
Yeah.
Let me start with the second one and go to the first one. So to me, one of the primary benefits of having a model like this is the deterrence factor, the idea that the SEC is actually looking at these types of issues, in my view, hopefully will improve the overall quality of the financial reporting. So will it become obsolete? Well, that would be my hope, right? But it's important for us to stay one step ahead of the game. Just as there are trends in market conditions, there are trends in reporting. And if it becomes clear that we are shutting down a particular type of accounting loophole, if you will, it's clear to me that firms will be creative and find other loopholes to try and attack. So if we're doing our jobs, it's not a static model. It's something that's under continuous development and continuous refinement. And as we learn from what we think is going on in the market, then it would suggest that additional factors have to be embedded in the model. So it's not a static model. Yeah. I'd like to think it's something that will move over time. And with respect to the second question, would we make this publicly available? I actually kind of chuckle when I hear that, because it's not the first time that anybody has asked me that question. And I think it kind of defeats the whole purpose of having a model if you are willing to tell everybody exactly how you are using the model. The factors that I talked about today are basically factors that anybody that's worried about beating the model would have been able to extract from the academic literature. There's no news in the factors that I was discussing today. It's important for us to keep the factors that we really think matter kind of quiet. Right? Okay. And so I have no intention of making this publicly available.
So the answer would be no.
It would be no.
Well, and I think along with this whole train of thought is if I was also responsible for risk with a public accounting firm, I'd also be following you incredibly closely, because I'd be wanting to run my audit clients through this kind of a thing as well, in order to be on the cutting edge, if you will, and not being a follower.
Yep.
Do you ever share the scores with the firms?
No.
No.
So my idea would be I'm not interested in having people be able to reverse engineer the model in an open, transparent way. I actually think that over time it will become clear that we are looking at certain things due to the type of comment letters we release. So there will be ways of essentially doing some limited amount of reverse engineering. But at the same time, it's not going to be anything that we deliver on a silver platter to people.
And if you can't answer this question, you can just say you can't answer this question. But would you ever think about company extensions as a factor?
I think everything is a possible factor. Take company extensions, for example. The choice of the use of custom extensions suggests that you think you're different from everybody else. And to the extent that you are different from everybody else, it seems like a perfectly legitimate exercise to find out why you're different from everybody else.
Okay.
I mean, let's face it, one of the benefits of XBRL is it's standardizing reporting across registrants. If everybody finds 50 different ways to report sales, that's not particularly useful for the people that actually want to use XBRL data. Sales is sales, right? And so, to me, the choices you make around the actual tags has information.
Very helpful. Thank you for answering that question. There's a series of questions here also that go to just XBRL errors in the filings themselves. Would you look at a firm, a company that had a lot of XBRLs, would that also be a factor?
Well, again, I would say so this reminds me of so I'm a professor, right? I'm a finance professor. And students always ask, what's going to be on the exam? And I have a common answer. If you ask me a question, I'm going to tell you yes. Right? That way I'm basically not giving any information. So if you think that if you ask me whether that's a possible factor, I'm going to say yes for the same reason that I'm not interested in sort of assisting people get to the end game.
Do you have any interactions with other parts in the SEC to help put in, I don't know if it's initiatives or programs to help improve quality of data within XBRL? Is it a big concern of yours?
Well, we know that there are a number of studies. For example, Columbia University released a study talking about XBRL, the quality of XBRL data. And I think that when I think about this more broadly, right, one of the real important features of the data and what makes it useful is if it's accurate and if there aren't errors. I would say, though, that there are a number of things that I believe I'm very optimistic about data quality moving forward. And that is any time you're asking a registrant to fill out a new form at the agency, everybody's on a learning curve, right? And so you fully expect initial filings are going to have errors because people are still getting used to actually submitting the forms to the SEC. Over time, though, and this is something that we've found, is that the error rate goes down as people become more comfortable actually submitting the forms. So I think that some of the error rates that we see in the data are partially because of people just trying to better understand how to submit the forms as opposed to an actual attempt to try and make sure that they're not comparable to their peer group. So that would be kind of the way I would look at it.
Okay. And I'm somewhat reading behind this next question, Craig, that talks about, it starts with the assumption that a hypothesis that there doesn't appear to be any negative consequences to setting XBRL tags incorrectly. So there's not a lot of, it feels like there's not a lot of incentive that's happening at the company level. What advice would you give to an individual to help them kind of persuade management to invest more time in high quality XBRL data?
Well, one of the things that I've said before that has been picked up is basically a response to some of the earlier questions you had, and that is, what would we do with sort of incorrect tagging? And I would say that if you're having a hard time getting your management team to take tagging seriously, understand that you are much more likely to be flagged by our model. So if you have a data error and we're using XBRL data and you have a sign error and you don't actually put the right sign in, you're going to stand out. It's not as if we're actually looking for sign errors, but to the extent that you stand out because you made a sign error, your ratios are likely to be out of whack and you will be identified as an outlier because you didn't take the time to actually have accurate data that synced up with your financial statements.
So at some extent, you're almost dependent upon those that write the comment letters at the SEC to include comments about XBRL quality data in it as well, to kind of have a complete loop of feedback to a company.
So that was more outside of my domain than you would, then I will probably choose not to actually say anything about that particular question.
So I've gotten 3 of all of the same question, which means it's very important to the group, and that is, do you have any idea about the timing of MD&A for tagging?
That is not something that the economists work on at the agency.
Does anybody else in the audience have any insight on that? Because I know some of you are really close to the SEC as she looks at Mr. Starr. Do you have any idea? No idea? Did the question come from you? No. That would have been highly embarrassing if that had been the case. Okay, well, you may have the same situation here. So let me just ask you quickly, and you can say no again. Do you have any interaction with the PCAOB?
About XBRL and tagging?
Yeah.
No, not directly. We do have a dialogue because they have a similar sort of a program for thinking about filers. So, I mean, I do talk to the people at the PCAOB on an informal basis, nothing formal, and there's no real just economists talking to economists more than anything else.
Okay, good. Do you have any thoughts you'd like to provide on inline?
Well, personally, I'm a big fan of inline XBRL. I think it's an obvious technological next step. If we're worried about sign errors and people overriding calculation, sort of features in the submissions, that inline XBRL solves a lot of those problems because it syncs the 10K with and makes them basically one thing. So I'm personally a big fan of inline XBRL.
Okay. And with that, those were all of the questions. So